my name's Emily Muscarella. I'm a former PwC auditor and current account executive here at FloQast. FloQast is a software company made by accountants for accountants to help teams achieve accounting operational excellence. Today we're going to talk about the chart of accounts. We're going to explain what a chart of accounts is, why it's important, and how to set up a chart of accounts for your small business. So what exactly is a chart of accounts? Basically, a chart of accounts, or COA, lists all the financial accounts in a company's general ledger, also known as the GL. This list includes an account number, account name, and a short description of the types of transactions recorded in specific accounts. A chart of accounts is usually grouped into 5 categories that correspond to the structure of a business's financial statements. Those account groups are: number 1, asset accounts. So examples include bank accounts, cash on hand, accounts receivables, fixed assets, and inventory. Number 2, liabilities accounts. Couple examples include current liabilities, such as accounts payable, credit card payables, accrued liabilities and customer deposits, and long-term liabilities like notes payable. Number 3, equity accounts. Couple examples include common stock, retained earnings, shareholders' equity, and draws. Number 4, income or revenue accounts. Examples include sales and interest income. Number 5, expense accounts, which include cost of goods sold or COGS, depreciation expense, and other operating expenses and overhead costs. A chart of accounts is designed to provide an overview of an organization's general ledger and help categorize every financial transaction a company makes. It assists management with reporting and decision-making and is also critical for meeting regulatory demands. Each of the accounts in your chart of accounts shows up in your financial statements. The chart of accounts helps direct where they will appear, whether they will be balance sheet accounts or income statement accounts, and how they'll appear on your statement of cash flows. If you don't set up your chart of accounts properly, your financial statements will be full of errors and misinformation. Again, the goal of a chart of accounts is to provide an accurate representation of a company's financial health. These best practices can help. Number 1, use a standard account numbering system. Account numbers aren't always required, but numbering them can help control the order as they appear on your company's financial statements and make them easier to decipher and more actionable. Most companies choose to use this common chart of accounts numbering system. Using this standard numbering system, your business might set up the assets section of the chart of accounts like this. Number 2, limit the number of general ledger accounts. One of the most common mistakes businesses make is having too many accounts on their chart of accounts. Unfortunately, this can actually limit the usefulness of the company's financial statements. When analyzing financial statements, you may want to compare expense accounts in certain categories over consecutive months or years. This can be difficult if there are too many accounts, since there's a good chance the same type of expenditures appear in more than one account. For example, without an organized chart of accounts, you might record your monthly accounting software subscription payment, to-dos and subscriptions one month, office expenses another month, and computer expenses another month. This kind of inconsistency leads to inaccurate budgets and useless prior period comparisons. A good rule of thumb is to never set up an account to track a specific vendor or customer because you want to be able to use your accounts to track multiple vendors and customers. For example, if you purchase office supplies for your business, don't set up different accounts for Quill, Office Depot, Staples, and Uline. Instead, just set up an account called Office Supplies and record all purchases of office supplies to that account. If you later need to know how much you spent with each vendor, you can run a vendor report to get the level of detail you need. Leave room between accounts. When setting up your chart of accounts, make sure different accounts are a few numbers apart from each other. For example, you might assign 1010 to your business checking account and 1020 to your petty cash account. This way, you have room to add more accounts as your business grows without losing the effective organization of your pre-existing accounts. Now let's talk about how to set up your chart of accounts. Most accounting software, including QuickBooks and Xero, come preset with a chart of accounts because the chart of accounts can be similar across like businesses. Templates are also readily available for download online. These templates can be a useful starting point, but your chart of accounts should be unique to your business. You will likely need to add new accounts that make sense for your business, delete those that don't, and rename any confusing accounts to something you, your bookkeeper, or your accounting team will understand and remember. To create a chart of accounts tailored to your needs, ask yourself these questions. 1, what do I want to track in my business? And 2, how do I want to organize information to best see my results and refine my strategy? We hope this video gives you the knowledge you need to set up your chart of accounts confidently. Now let's review what we've learned. A chart of accounts is a list of all of the financial accounts in a company's general ledger. It typically includes an account number, account name, and a short description of the type of financial transactions that belong in each account. A chart of accounts is grouped into 5 categories that correspond to the structure of a business's financial statements: assets, liabilities, equity, revenue, and expenses. Each account in the chart of accounts shows up in the financial statements, and the chart of accounts helps direct where they will appear. If you don't set up your chart of accounts properly, your financial statements will be full of errors and misinformation. Most companies use a common numbering system and limit the number of accounts they use to help keep the chart of accounts organized and facilitate comparisons between accounts over consecutive months or years. And finally, many accounting systems come preset with a chart of accounts, but you will likely need to add new accounts that make sense for your business and delete others that don't. Hey, if you found this video useful, hit that like button and don't forget to subscribe. That's all for today. Good luck with setting up your chart of accounts.